Welcome back to Crypto Wealth Daily, your daily edge in crypto. Yesterday, the entire crypto market was rocked by a massive sell-off. Bitcoin, Ethereum, and altcoins plunged across the board. But what actually caused this crash? Today, we'll break down the real reasons behind the drop and what it means for the market going forward. The biggest trigger came from traditional markets. Former President Trump announced 100% tariffs on Chinese technology and software exports, reigniting trade war fears. Stocks tanked, the dollar surged, and investors ran from risk assets. Crypto, still viewed as a speculative sector, sold off instantly as panic spread through global markets. This shockwave wasn't isolated. It hit at a time when market sentiment was already fragile after months of sideways trading. As news spread, major exchanges saw a flood of sell orders. Bitcoin dropped below key support levels, taking the entire market with it. It was a domino effect that began with politics but ended in a full-blown crypto meltdown. Within hours, more than $16 billion in leveraged long positions were liquidated across Bitcoin, Ethereum, Solana, and other major altcoins. Traders using 10 to 50 times leverage were completely wiped out. These forced liquidations triggered a cascade effect as positions were closed. Prices fell further, causing even more liquidations. It was a textbook liquidity spiral. Exchanges like Binance, Bybit, and OKX saw record liquidation volumes. Even strong hands were shaken out, as cascading sell orders pushed prices to multi-month lows. In short, the crash wasn't just panic. It was automated liquidation systems working overtime in a fragile, over-leveraged market. Beyond the tariffs, global macro conditions amplified the pain. The US dollar hit new yearly highs. Treasury yields surged, and investors rotated out of risk assets into cash. When the dollar strengthens, crypto typically weakens, and this time was no different. Risk-off sentiment dominated across stocks, bonds, and digital assets alike. Add in global uncertainty, rising oil prices, and slowing growth data from Asia, and you've got a perfect storm. Institutional traders reduced exposure to crypto futures, while retail investors fled to stablecoins. The result was broad-based selling that left no sector untouched. Bitcoin's correlation to macro markets proved stronger than ever. As fear spread, on-chain data showed massive Wallet-to exchange flows. Whale's large holders began sending Bitcoin and Ethereum to exchanges, signaling intent to sell. This wave of selling pressure deepened the drop. Analysts estimate over $2 billion worth of crypto moved from cold wallets into exchanges in under 24 hours. These whale moves often mark the capitulation phase, the moment weak hands fold and strong hands prepare to buy. The question now is whether this selling was panic or strategy. Some on-chain data hints whales could be using the crash to reaccumulate at lower prices, setting up for a possible recovery rally in the weeks ahead. So where do we go from here? Historically, every major crypto crash creates long-term opportunity. Bitcoin has survived dozens of corrections, and each one has set the stage for higher highs. With liquidations cleared and leverage flushed out, the market is healthier. The key now is patience, strategy, and watching for institutional re-entry. This video is for educational purposes only and is not financial advice. Always do your own research, manage risk, and consult a licensed professional before investing. Volatility can create opportunity, but it can also lead to major losses. Stay informed, stay disciplined, and remember, smart money never panics.